Good evening, everyone, and welcome to our first RBA Decision Debrief. And it couldn't have started off with more of a shock, as the RBA made a decision that a lot of people didn't expect. And we'll be here to unpack it, answer any questions. So if you are on the Facebook group, please feel free to ask any questions. For the people who are on live as well too, please feel free to ask questions. That's what it's all about, and keep you guys informed as well too. Now, obviously, the decision was made at 2:30 today. So I have put together a bit of a presentation that we'll go through in regards to the decision, some of the key points around that, and what the impacts are for people as well too. All right, so let's get started. So before we get started, general advice warning. Obviously, the information that we go through today is of a general nature. We haven't taken your personal circumstances into consideration, but as your financial advisors, if you need anything, please reach out. We're more than happy to help. So let's get cracking. So let's see where we're at. So RBA decides today in a shock move to lift the interest rates, the official cash rate from 3.6% to 3.8%. And what you can see is that there has been a major uptick since the lows of a 0.10% cash rate only around 12 months ago. I think it started in May 2022, the increases, and we are where we are today. So, a fair bit of a rate hike, obviously, for the people who have mortgages. This is, putting more pressure on them as well, as well as the people who are self-funded or who do have savings. They are getting more bang for their buck. But because of this such a rapid change over a 12-month period, and something that we haven't seen for a very long time, as you can see here, the cash rate, especially since kind of the GFC, you can see that it's kind of continued to stem, go down. This is the kind of COVID period. And we've really, the last time we had a significant increase in here was back in 1994, and still it wasn't the increases that we're having today. So the impact of these cash rate increases are going to be felt across the board as, people with debt, which is a lot of people in Australia, continue to kind of be, paying more on their mortgages, and therefore, losing surplus cash flow. And then what the RBA is hoping to do is kind of stem that spending to slow down the inflation. Now, for people that jumped on Lunchtime Money Live on Monday, and I'm yet to get out the email in regards to everyone, but I will, coupled with this video as well too. What was the shock was that this is the expectations that was in the market before the RBA's cash rate. And as you can see, which we talked about, all indications from all so-called experts was that there was not going to be a rate increase this time round, with 100% saying that there was going to be no increase. And that essentially it shocked the market, okay? And we'll see what happened in the stock market from this decision, and you can see what happens from the shock. But, Mason and Nick, we were talking about, and we had a little bit of a giggle that it was, 100%, because it can never be 100%. And it happened to kind of fall that way, didn't it, Mason?
It did. It was, it's funny that I spoke about this yesterday. It's anything when it comes to money, like this, it just shows like gambling is a bit silly when it comes to these types of things, because it looks like a sure bet, but apparently it wasn't. It's a big shock to the system, and we'll go through what's happened to the market as well. It's funny how when expectations don't get met, what sort of happens when it comes to money and things. But I always like to say, until it's money in the bank, it's not guaranteed. And this is what is shown here as well.
Yeah. And what about you, Nick? Because I know, 100% was a bit of a shock to you as well too, and that's obviously panned out that way as well.
Yeah, I definitely thought 100% was a bit interesting and somewhat worrying, I guess, because we can't predict it. But this rate rise does feel a little bit different to previous rate rises, in the sense that, I do feel that there was, quite a big proportion of people that just were not expecting it. And whereas in the past, I think there were more expectations of there being a rate rise, and so people weren't as surprised by it. So I think this one has come as a shock to a lot of people, as we've seen sort of in the drop in the share market as a result.
Yeah. And for learning for a lot of people, I want everyone to know that you can't predict, but you can prepare. And especially in a lot of the plans that we've done, we've set a lot of the home loan rates at a much, much higher rate than you're paying in your home loans as well too when it comes to our modeling and stuff. And this is for the reason. So always remember, we can't predict, but we can prepare. And so over to the stock market. And if you talk about hitting a brick wall, look at what happened at 2:30. So essentially, market was traveling not too bad in the early day, in a full expectation that there was going to be a pause or another pause, at least in regards to the cash rate. And once the governor announced at 2:30 that they were increasing the cash rate to stem inflation, essentially the stock market hit, a brick wall. And this is the ASX 200. So this is the top 200 stocks. And essentially what you can see is that it essentially plummeted, okay, in that period of time. Now, this is a very, very short-term window. This is a day basis. It has recovered a little bit from the point in which I've done this slide, okay, but nowhere near where it was at the start of the day in regards to trading of this. And this goes to show that just in regards to expectations, and also in regards to another big point that I want to make in regards to algorithms when it comes to investing as well. Just so everyone knows that there's a lot of big fund managers out there that use algorithms based on data points, okay? And for example, if the cash rate increases, the algorithm in the back of these investment vehicles says cash rate increases, expectations going to be changed, therefore make this certain move. Coupled with the point of people making decisions in regards to trading as well too. So there's a lot of the reasons why this move happens. It's just not, everyone waking up and just going, "Ooh, we didn't expect this and we want to sell." There's a lot of input algorithms inside these fund managers that are deploying these moves based on the data. Now, over to the RBA, and what we wanted to do is just break down kind of the 10 main points, and maybe Nick, I might start with you, and then Mason, you do the first 5, and then Mason, if you do the next 5. So Nick, over to you. The first 5 points that we kind of summarize for everyone.
Yeah, well, I guess the first one is the decision itself. So the 0.25% increase. And I guess it primarily looks at, inflation. So moving on to the second point, inflation is still fairly high. So they're wanting to reduce it down to the target range of 2 to 3%. But as at the March quarter, the increase in CPI was 7% for the 12 months leading into that quarter. So still fairly far beyond the range that they want to get to. The third point is that they held rates steady last month. And I think that, maybe a lot of people thought that they would continue to hold them steady because it is a bit of a fine balance between bringing inflation down and also not, providing too much damage to mortgage holders, which is a significant portion of the population.
And on that point, Nick, I think a big thing is to say that they're making this decision because they believe that the economy right now is able to handle it as well too. Yeah, so them taking a pause and assessing the scenario, we've only got to think about last month. There was a lot of US bank failures. Obviously, there was a big one that happened overnight as well too, but they're looking locally as well too, and they're saying, okay, well, the economy is pretty good. We're in a pretty good spot. It's actually still growing at a rapid rate. We need to get this under control because, as everyone knows, going to the grocery store and getting a couple of bags and coming out, it's $150. That's not good for anyone. Okay, so they need to get that under control, which brings us on to the next point.
Yeah, so the next point is about the difference between inflation between goods and services. So we've seen a bigger increase in services, and I think it's a little bit, to do with the fact that we've seen wage growth still at about 4% annually. And so this kind of flows on to, in the sense, if you think people are asking to earn more money, then businesses have to charge more for their services. So it can trigger a little bit of a wage spiral is what they call it. But they essentially want to avoid that to continue to spiral.
And the worst thing is, Nick, and for everyone to know, is that the biggest thing is around inflation expectations staying around. So tackling inflation is one thing. 2, tackling inflation expectations. Because if people are expecting inflation to continue to soar or continue to increase, what that does for businesses especially is that they're going to bake in those future costs. so that they don't have a Porter Davis issue, that they don't have these building issues that are happening where they haven't priced in these expectations. So if you rewind to many years ago when the RBA came out and said they were going to keep the cash rate at a low rate till 2024, businesses made those decisions based on those numbers, expecting inflation to be at a much more lower rate and cash to be freely used in that time. So services, when they're seeing that, that's a sense of this inflation expectation continuing to stay around, and businesses continue to do that. So the RBA wants to tackle that to remove that inflation expectation as much as possible. So the next one's a big one because it's the number that I've been looking at as well too in regards to the labor market.
Yeah, so it's still at pretty much the lowest point it's been in sort of 50 years. So it's around 3.5%. And typically, you know, for the economy to be slowing down, we generally see unemployment figures rise somewhat, and we just haven't seen that yet. So I guess it's another indicator that the RBA looks at when they are making these decisions.
Yeah, definitely. All right. Now, Mason, over to you. Yeah, in regards to some of the other points, and for everyone watching, please feel free that I'm going to go around and ask for people if they've got any questions to please ask any questions that you may have, because we want to make this as informative and valuable for as many people as we can. So, Mason, over to you.
Yeah, well, speaking of that tight labour market, so wages growth has picked up in the response to it and high inflation, of course. But the board is alert to the risk of ongoing high inflation contributing to large increases in prices and wages. So, John, I think you just touched on that and why that is the case. It's quite interesting. So it's quite a difficult thing the board's sort of trying to manage at the moment. As you can see, lots of different factors.
Now, Eva, you're going to wet, so put these ones on because I watched the video. Okay.
Yeah, 1 second. I'll just throw. Thanks for joining, Nicole, but I'll just pop her on mute. So keep going.
Yeah, absolutely. So, and the board's priority is to return inflation to that target range. That they've been pretty steadfast in that. They've constantly said that's what they're trying to do. As high inflation can make life difficult for people, and we're seeing this. It is becoming difficult for people. So they do need to do something because it is going in the right direction, as Phil said. I'll call him Phil, my mate.
You've shortened his name, mate. You're on first name basis. I'm sure you've shortened it as well. So I think the biggest thing to take away from that statement as well too is that they're steadfast on getting inflation where it needs to be, and they're not going to come out and say this, but like Nicola was saying before, they want to see unemployment rise, which essentially is not a good thing. Like, no one wants to see unemployment rise, but they need to see it rise because that means it's tackling inflation, and they're hell bent on this. So, you know, there is going to be some economic damage that's made from this, and everyone's starting to see it. The hip pocket is getting thinner and thinner and thinner as things become more costly. Okay, but just remember that the cost of goods going up each year, okay, is not a good thing. Okay, you don't want to have some inflation. You definitely don't want to have hyperinflation. And you know, it's really the sole purpose of the RBA to ensure that this is the case. So, yeah. Keep going, Mason.
Yeah, no, it's spot on. And that touches on to the next point around household consumption. And the outlook on this remains uncertain due to these higher interest rates, cost of living pressures, and decline in housing prices, leading to substantial slowing in household spending. So exactly as you just said, John, this is what the RBA wants. They want household spending to slow down in a big way, which it looks like it is, which is for them a big tick. It's great.
What's very interesting, Mason, and everyone, is that at the same point, there's a review going on at the RBA at the moment in regards to their policies and what they need to do. And over in New Zealand, just across the pond, New Zealand has got one of their policies for their central bank to keep a handle on housing prices in New Zealand. So it's one of their policies to make sure that there's a policy to accommodate for that. Yeah. But I want everyone to know that that's not in the RBA's wheelhouse. They don't care. Like, housing prices is not a part of their policy. Okay, theirs is around inflation, stability in the economy, and if that means that there's a consequence on housing prices, well, that's just for everyone to know. Yeah, this is a consequence of a high debt leveled country when it comes to housing debt. But yeah, obviously that has flow-ons in regards to the economy, and that's what they're more worried about. You know, building issues, construction companies falling, you know, tradies losing their jobs, so on and so forth. So there's no specific, but there's probably an indirect approach from the RBA in regards to some of those comments.
Yeah, and speaking of the economy, John, so basically the central forecast is for it to continue growing, albeit at a below trend pace, with GDP forecast to increase by just 1.25% this year and around 2% over the year to mid 2025. So definitely a slowing there, but I guess the optimist is saying at least it's still growing at this point as well.
So Mason, IMF comes out, which is the International Monetary Fund, and reduces the expectations in regards to growth being around 2.5% globally, okay, meaning that the world economy is growing at approximately 2.5%. And what does that mean, Mason? Like, you know, is that a good thing? Is that, like, in my opinion, like, the IMF is usually quite optimistic. Yeah.
Yeah, so you're right. The IMF is usually optimistic. So the fact that they're not quite as optimistic as they probably once were is a bit of a cause for concern. But yeah, I think considering everything that's sort of going on, it's to be expected, I think, as well. You can't just keep growing at these record paces forever. It does have to revert back to the mean at some point. And to revert back to the mean, you also have to go experience periods of lower growth. So I think it's just all part of the cycle.
Yeah, and I think there's a lot of geopolitical issues that are happening at the moment. I think the world economy is also changing everyone as well too. We're going from a full globalized, full steam train to this kind of regional area kind of trading scenario. And there's, you know, certain countries that are teaming up with other, you know, the BRICS, as people kind of call them. They're kind of teaming up. You've got the West that are kind of teaming up. You've got, you know, the Ukraine-Russian war that unfortunately is still happening. We've got Taiwan issues that are brewing over there. And so when you look at a global front, things that it could be growing might not be growing as well too. When we talk about Taiwan, you know, talk about the semiconductor kind of train that's coming out of there. Does that shift? Does that move elsewhere? You know, are we having growth in places like India, okay, that is growing, in Africa, where it was once China that was the booming economy? And, you know, there's still issues that are happening across there as well too. So for me, they're quite optimistic because, you know, there's a lot of things brewing in the world, but what does that mean to investors? You know, for investors, you need to look at this and say, this is once again diversification we need it, okay? It's not a matter of just, you know, putting all of your money into 5 or 6 stocks in the US stock exchange and hoping that they're going to be glory. You need to diversify. You need to be making sure your eggs are not all in the one basket, and you also need to be making sure that your investments are inflation hedged. Okay, because inflation is a big thing. And when we're looking at building people's portfolios, you can always see that we don't have your eggs in one basket, and we try and make sure that you're diversified as much as possible. The US economy is the biggest economy in the world, everyone. It ranges from about 50 to 60% of the world economy. And so you will have a lot of exposure in the US subsequently. But, you know, when you take out the US, we try and be as diversified as much as possible. Okay, we will break that down a little bit more. Yes, you will always have a heavy weighting towards Australia because of some of the things like franking credits and some of the benefits that you get from a tax position in regards to Australia. So you will sometimes always have a little bit heavier on the Australian side than you will on the international. But as a whole, we're wanting to make sure that not all of your eggs are in one country, you know, and having issues there. When you look at Sweden, for example, they had a lot of money in the last 3 banks that just collapsed in the US. Yeah, a lot of their funds that they were investing in were in the 3. So, you know, as an investor, you wouldn't want to be holding a lot of money in Sweden. And I can kind of take this back to GFC times, and I want everyone to use this as a little bit of a lesson. When the GFC happened, there was a thing called the pigs. Okay, Portugal, Italy, Ireland, Greece, and Spain. Okay, and if you remember back then, and I think about, it was after the GFC, but it was a little bit later. Essentially, you go to a Greek bank, try to pull money out of an ATM, and you couldn't get your money. Yeah, the countries were essentially becoming bankrupt. Okay, so when at that point in time, our exposure in regards to the pigs, yeah, was less than 2% across our clients' portfolios. Okay, so diversification is cool. It's good. It's the key to investing success. But this is a clear reminder when one statement from the IMF and the RBA means a hell of a lot. It's around grabbing that information and computing that and reminding yourself what to do. But I think the last one, Mason, is probably the most important. And Phil kind of likes to leave the most important one to the last, doesn't he?
That's it. I think he tries to hope that everyone just doesn't read to the end. But the last point is probably not going to make me very popular to say, but some further tightening of monetary policy may be required to ensure the inflation returns to target, but that'll depend on how the economy and inflation evolve. So I think two things. I think inflation needs to continue trending downwards and a bit, maybe even a bit quicker than it is currently, because it's probably not going as quick as Phil Lowe wants. But also this unemployment thing. While unemployment remains low, that always gives him the green light to go again and go again. Because until that sort of moves, like, oh, well, people's still working. So there's still money. So therefore, people can pay their mortgages and keep bumping that up. So interesting times ahead. And I'm not going to lie, I was surprised by today's result. But in saying that, now reading on what Phil Lowe commented on, I'm not surprised. So it's quite interesting how it sort of all, I think his decision actually makes a lot of sense, even though it's unpopular.
Yeah, I think a big one, circumstantial, if you kind of take the last pause into consideration. So when you take the last pause into consideration, that was more of a shock that they paused rather than not. And so it gave him the license to be able to do it now. Okay. But I think there's some other key measures that they want to be looking at as well too. I think the other one is around, the services inflation as well too, making sure that inflation expectations around services is under control. And I think the other one as well too is in regards to mortgage defaults as well too. So as people are rolling off these fixed interest rates, and I was speaking to Anthony today and he goes, John, they're starting to come real now, thick and fast. Yeah, that's the other one. Because if they start to have defaults, that causes ricochets across investments. Not to say that it was a GFC kind of event that were going to happen in Australia. I do think that our banking system is much more sound than the US is even now. But that mortgage stress and that ability to pay down debt, and also the available cash that's available in banks, which they can get data as well too pretty quickly and pretty swiftly. If they start to see that start to blow up and coupled with unemployment, you could probably see the inflation come down as well too. Nick, I know we were speaking offline around, the interest rate. I made a comment around, and I wanted to share this today for everyone, is that I also want people to know that the RBA wants to have interest rates at a level where they've got enough in their arsenal and enough in their kit that if the economy turns south, that they can also decrease interest rates as well too. So I know everyone is experiencing the interest rate rises, especially with their mortgages and trying to grab a grip of that, okay? But the reality is as well too, is that if they weren't doing this, the cost of bread, milk and stuff will be nearly as much as the interest rate costs in themselves, yeah? And at least this way, if the economy turns south, so if unemployment rises, defaults start happening, so on and so forth, well, the RBA's got in their kit bag this ability to drop interest rates to then accommodate for that kind of economic cycle. You don't want it to be what happened in the US, for example, which pretty much went to zero after the GFC. And so what they started to do was do major QE in regards to actually making sure that they're spending money or pumping money into the economy to just keep it alive. Yeah, at least in this way, they can go back to a natural course, which is interest rates rise in regards to the inflation, deflationary time, drop interest rates to be able to accommodate for them. So everything that's going on at the moment, I just want everyone to know, this is pure textbook stuff, isn't it, Nick and Mason? This is textbook, economics.
Yeah, it'll be interesting to see how quickly it does slow down, when it does slow down, I guess, because there is that portion of households that haven't really been hit yet, like the households that are on the fixed rate mortgages. Like there's going to be a lag effect from when, there's all these rate hikes been happening. But if you've been on a fixed rate mortgage, essentially nothing's really changed for you yet. And it will in the future. So yeah, I think that'll sort of, I guess, decipher how quickly it does slow down when those households start to get impacted.
Definitely. Now, question time for anyone. Daniel, Dry, and Nicole, thank you very much for joining live, and obviously everyone on Facebook as well too. But Obviously, this is our first time around doing it, so we are open to any further questions as well too if we haven't covered anything. But please feel to ask any questions that you may want to know, or so we can cover it for you today.
Yeah, I've got one. What is the optimal unemployment rate? Like, what would they like that to sit around?
Yeah, that's very good. There's actually give me 1 second, Jai. I'll pick that up because there's actually a limit that they actually there's actually a limit. Just give me 1 second. So it's actually in their policies. Give me 1 second. I don't want to give you the wrong answer, yeah. But there is a range. I just can't find it. I'll put it in the Facebook group and I'll email it. I'll email it a part of the email as well to Jai, if that's all right. Yeah, but there is actually a range that they actually aim for. Yeah, and they also don't want to go obviously above that range as well too. Yeah. 5 or 6% sounds familiar for me, Mason. It might be right on Nicola. Yeah, it sounds familiar, 5 to 6%, but I'll get back to you on that. Okay.
Yeah, it's around that 5 figure. That 5 figure really rings a bell. And it just sounds about right too. Not to say anything, but yeah, it's interesting though, isn't it, when it comes to unemployment rate? Because during COVID, they were loving that it wasn't very high. Like, we still had all our jobs and things. So I think it also depends on the times we're in as well. Like, sometimes having that lower rate there is a really fantastic outcome. More people working, people feeling good about themselves and having a job and money to bring in is a really, really good thing. But at times like this, not so much for the RBA. So it's just interesting how quickly things can change, and how quickly we sort of need to adapt as an economy as well. It's quite interesting. Never
definitely. Yeah, when that dot point came up, I was a bit shocked actually. But yeah, they want that to rise to help slow inflation. Yeah,
they need to actually, as a consequence, to make it fall. They know that once that's happening, that means that businesses are feeling the pinch, and they're laying off staff, and in most businesses, wages are the biggest cost on their profit and loss statement. So they do that to trim that up and to keep them afloat. So that's the key indicator that they get from there. But like I said, I'll look into it. But I've got a feeling it's around that kind of 5 to 6% range. Yeah.
Awesome. Cheers.
All right, Daniel, no questions. Thanks for running it. Very informative. Have to drop into a meeting. Thanks, Daniel, for jumping on. Really appreciate it. All right. Over to Facebook. If there's any questions, please let us know, or else we'll wrap things up. Obviously, I'll send this out for the recording for everyone to watch at a later date. But please feel free if you've got any follow-up questions in regards to the RBA's decision and obviously what it means for you personally. Yeah, please reach out to me or your advisors, and we'll be happy to help. Okay. Well, once again, thank you everyone for joining, and we'll see you next time. Cheers. Have a good one.
See you guys.
Thanks.
See you guys.